Hey scholars, now we're going to chat about the variable interest entities. This is a tough one because this is where you don't necessarily own over 50% of the stock. But because of other circumstances, they make you consolidate with the company because you have a financial stake in that other company. That company has a very strange, it's lacking normal characteristics of equity ownership, and you'll be the biggest winner or loser. So let's make sure we understand it, and then we'll try a big full-blown problem. The very first thing we want to look at is we have two companies, and a company has a variable interest in another entity whenever you have skin in the game. And that would be the company and the business had an arrangement. The business that you're looking at possibly consolidating has to be a legal entity. You have to determine if there are any of the exclusions that apply. And by the way, there are exclusions. You want to be aware of those exclusions. Some of the biggest exclusions, which we studied in the course, were not-for-profits do not get consolidated, employee benefit plans, registered investment companies, separate accounts of life insurance, and government organizations. The big one there that I would say you should know is not-for-profits and pension plans. Those are not consolidated. And then, of course, it has to be more than insignificant. So that's really where you're going to start. So all of the following criteria must be met. You had an arrangement. The business entity is a legal entity. It didn't qualify for the exclusions. And remember, an exclusion in this particular case would be the not-for-profits and, of course, the pension plans. So we look at all of those. Then the next thing we do is the entity itself is a variable interest entity. And when is it a variable interest entity? Well, it is a variable interest entity when there is an insufficient level of equity at risk. They didn't put in the money. They don't have the ability to make the decisions. They don't get the profits, and they don't suffer the losses, right? Those are really normal equity structure issues. The owners put in the money, the owners make the decisions, the owners get the profits, the owners suffer the losses, and finally, some of the equity investors have disproportionate few voting rights relative to the amount of money they put in. So if you have one of those situations, and that was where I put in $1,000 and get 1,000 shares, you put in $10 million and only get 2 shares. Clearly, it looks like I control the company, but you, the person who put the largest amount in, got a disproportionately small amount of the shares. But you now are trying to usurp the rest of the rules, and they say, that doesn't work. So that would be the classic example. So if yes, both, then the question is, do we consolidate? And towards that, we ask ourselves, do you have the ability to direct the VIE's activities, the activities that will most likely be directly resulting in them having a profit or a loss? Well, do you absorb most of the losses or the returns, the profits in this particular case? Those would be very important aspects to look at. And depending on that, the company is deemed to be the primary beneficiary. If you can direct the activities and you absorb a significant amount of the profits or losses based on those activities, then yes, even though you don't own a majority of the shares, you must consolidate.